Today's video is about the Relative Strength Index and my understanding of how Thomas Bulkowski uses it. I will also be reviewing some charts as well. To begin, I want to go over a paper that Thomas Bulkowski published and that is available on his website, thepatternSite.com. In this paper, he talks about the RSI and how he uses it to trade. He begins by saying that the Wilder Relative Strength Index, RSI, is a price momentum indicator that is useful for intraday trading. Values above 70 mean prices nearing a top, overhead resistance, or correction of the uptrend. Values below 30 mean prices nearing a bottom, support zone, or retrace of the decline. The RSI primary value is calling the turning points in a trading range market between support and resistance. Now, you heard me say this before, and this is where I get it from. Thomas Bulkowski says, please note that the distinction of the signals does not occur when price enters the overbought, oversold region, but as they exit the region. The stock can remain overbought or oversold for long periods. The exit strategy allows price to continue moving in the desired direction until a trend change becomes evident. And he has an example here above. You can see these buy and sell signals. Simply when the RSI is initially leaving the oversold or the overbought level, and how the price is finding a peak or a valley at those points. I'm going to take a look at the SPY in the same time frame of this example chart, which is 15 minutes and 10 days, to see how successful that might be. I have placed yellow arrows on the RSI where the price is reaching outside of the oversold region, and there are a few doubles here. Bulkowski wouldn't have shown these doubles, but I did anyway. Above on the chart, I have in red circles shown where the buys are, and I have buy in red because that's money leaving my account. There would have been 3 buys here, 1, 2, and 3. The next sell signal coming as the RSI falls out of or below that overbought level, below 70, and that's where the sell would be right there. And you can just see very quickly that these 3 buys would have proven profitable had you traded the RSI here as Thomas Bulkowski described. One of the most valuable things we can get from studying the RSI is an understanding of divergence, where trends reverse. Bulkowski writes, divergence occurs when price makes a lower low, but the indicator makes a higher low, measuring lows to lows, but again, against the trend of the price. He continues by saying, or when price makes a higher high, but the indicator makes a lower high, again, comparing the highs in divergence. The price trend diverges from the indicator trend. Often, but not always, price follows the indicator. I'm going to jump to American Eagle Outfitters and see how that works. Alright, I have the 4-hour chart of American Eagle Outfitters pulled up. We can easily see that there are 3 levels of resistance here, and they are shown in yellow horizontal lines on the price chart. Looking below at the RSI, you're going to see these red lines. And these red lines show when the RSI is making higher lows, when the price trend is making lower lows. This is the divergence that Bulkowski was referring to. This would be bullish divergence. You will notice though that there are a lot of tails here reaching below this line. And the importance here is that the RSI is taken from the closing price of a candle, not anything in between. So on a line chart, this would be more clear. I prefer to use candle charts, so I'll just be ignoring tails and wicks. Now you can see that these 2 red lines move against each other, and this is a bullish divergence. And as you can see, the price is reaching and bouncing off of one of these resistance levels. So at this time, this would have been a good time to buy. And sure enough, the price rises until the price hits another level of resistance. And this level of resistance is defined by the level at which the price gapped down. Any trader will know that this is likely to be an area of resistance prior to it proving to be so. As the RSI rises, it fails to reach the overbought region, and this is a bearish omen. This is why I say things like, I want to see the RSI hit overbought, because if it doesn't, it turns around. That means that the bulls lost momentum before gaining any true strength. And sure enough, the price fell. And once the price broke through that level of resistance, it continued to fall until it reached the oversold region. And you can see here that again, we have higher lows in the RSI, but the price is making lower lows. And again, I'm ignoring wicks, and I'm using these 2 candles here. This proved to be bullish divergence, and the price did rise from that point until it came back up to about that same level of resistance. At which time, the RSI keeled over again, another bearish omen. And sure enough, the price drops until the price hits this level of resistance. Now, the RSI did not reach oversold, I would call that a bullish omen. In other words, that the bears did not reach a critical point of momentum prior to the shift. And these omens are not necessarily for trading. These are just indicators I use to help give context and understanding to it, or how the price may be behaving. As the price rises from that bullish omen, it pierces straight through that middle level of resistance, nearing the overbought level and oscillating up in that region. And you can see here that the RSI does not fall below 50. This is still very bullish, especially as the price reverses back up after reaching to a low of 53 on this intermediate resistance line here. So the price continues upward, and the price sets high after high after high as the indicator sets lower highs. And you can see this in the red lines and the gray circles once again. This is bearish divergence, and sure enough, the price falls until it reaches that intermediate level of resistance and turns around before reaching the oversold region on the RSI. This would be a bullish omen, and the price did move back up to that top level of resistance and turned around again. I don't trade on these omens because honestly, the price is just waffling back and forth. There isn't a clear move here for me to trade on. And Bulkowski also brings it up in the paper. He says to ignore anything that happens or any turns in the RSI that do not occur in the overbought or the oversold regions, at least for trading. And I would have to agree with that. So far, the RSI has been one of my primary indicators in my day trades, and I have found it very, very useful.